Hello, and the bond market may not grab headlines like equities, but right now it's where some of the most interesting dynamics in global finance are playing out. A warm welcome to The More You Know, the podcast from STANLIB Asset Management. I'm Jeremy Maggs, and my guest today is Sylvester Kobo, who is Deputy Head of Fixed Income at STANLIB. We're going to explore the fixed income landscape, how a lower inflation target, renewed foreign interest in South African bonds, and a strong dollar are shaping returns and positioning, and why, as Sylvester puts it, the short end of the curve still matters. Sylvester, a very warm welcome to you. So, Sylvester, a very warm welcome. Let's start with the big picture question, and we'll deep dive a little bit later. But what's really driving the bond market right now?
Thanks, Jeremy. I think two main factors. Locally, it's the move by the Reserve Bank to adopt a lower inflation target, so moving from 4.5% to 3%. Even though that is not formally done or finalized as yet, the market has moved to price it in, which has driven bond yields lower. And then the second factor, I would say, it's more on the global side. We've seen this year, easing financial conditions. And by that, I mean, inflation has continued to come down globally, which was followed by interest rate cuts across the board, which supported bonds and other risk assets. And then two, we've seen the dollar weakening materially. And that was largely around the nervousness of this new Trump administration and what it means for U.S. assets. So we've seen now investors actually diversifying away from the dollar and U.S. assets, looking for opportunities elsewhere. So emerging market currencies and emerging market bonds benefited from that as investors were hunting for yield. So South African bonds, as part of that and screening very well in the emerging market space, benefited. And we've seen, bonds year to date have done 14%, which is a lot.
I want to come back to inflation in just a moment, but we've got those drivers. So how do these interact or coalesce to shape your outlook?
So for investors that are governed or, invest on macro fundamentals, you can't ignore. So these themes, yes, the inflation part is more, macro fundamentals, but the others is more sentiment. We have to bring in the, macro overlay. And for South Africa, if you look at the growth dynamics, they've been bad for the last 10 years or so. And it continues to face some headwinds. So in our mind, low growth environment for the next few quarters probably supports a lower inflation trajectory, and which gives the Reserve Bank space to cut interest rates even more. And that will continue to support bonds. But on the global side, if you make a case of these foreign inflows continue to come or the move away from dollar or dollar-based assets continuing, you need to then start thinking around what the dollar does from here on. Because most of these flows have been unhedged, meaning if the dollar were to reverse the weakness, you're probably going to start to see foreign investors selling our bonds, which maybe provide a bit of a challenge. But net, in this muddle-through environment that we have, we think in the short to medium-term, bonds should be supported, especially going into the medium-term budget policy statement in November.
Are we nearing a point then when rate cuts could start to influence the curve a little more meaningfully?
Yes, definitely.
Can you amplify that for me a little bit?
So the bond yield curve, the short end of the curve, mostly reacts to inflation and interest rate dynamics purely. Whereas on the longer end of the bond curve, you have to bring in the fiscus, what the government is doing with the budget, so spending revenue dynamics. So because now this move or the lower inflation expectation anchors inflation at 3% compared to 4.5%, you actually need the short end to continue to grind lower. Because if you think that in the thinking of the SARP or in their projection, they're saying, at the end of 2027, interest rates could be down by another 125 basis points, which means the short end of the curve can continue to move lower, which is positive for that area. Whereas when you talk about the long end, you need to now start thinking growth, budgets, what the politicians do, and then the municipal elections coming up next year.
So the short end still matters. I understand that's the focus. Now let's thread it back, if we can, to opportunity for investors.
I would say for those investors that are in your multi-asset income fund type, so your flexible income fund type mandates, this environment benefits them materially, because what those mandates does, because they afford us as managers flexibility to increase duration, to capture some of the capital that will come with the lower end or the shorter dated bonds coming down, we're able to capture that value for them. Whereas for investors that are more risk-seeking, they want to be in the pure bond fund. I would say for them, the shorter end of the curve is expensive now. Probably the value is more in the barely to the long end of the curve, because South African yield curve is still very steep. The short end is expensive for those kind of investors. But I guess, this is our roles as investment managers, right? You leave us to make these kind of decisions for you, and we actively manage our portfolios to capture those nuances at the different points of the curve.
So how important then is duration risk in this environment?
It's very important. Duration essentially captures the sensitivity of the funds to interest rate movements. And because I said globally easier financial conditions largely leading to interest rate cuts, South Africa moving to a lower inflation environment. So you also means more interest rate cuts to come. So it's important that managers manage the inflation risk actively, and because it provides opportunities at different points. There will come a point, I'm not saying bonds are buy, close your eyes, or, buy and hold to perpetuity. But for where we are now, there is space for bonds to take duration. But at some point, I would think if the market were to go another 50 basis points, it's probably time to take off duration out of the portfolios.
All right. So now let's bring the conversation into the STANLIB Flexible Income Fund. I want to work that into the conversation. How, against the backdrop that you've just given us, how does your current positioning reflect these views on the curve?
So based on what I've just said, you would expect that duration in the portfolio has been picked up, which is the case. And there, basically what we're doing, we're taking the view of we're going into the medium-term budget. So where the market is now, I think it captures or it's pricing in all the interest rate dynamics. What is not pricing in is the possibility of the government or the National Treasury to cut bond issuance next month. And we think that's still to come. That's why we've increased duration in the portfolio. And other risk assets like property in the portfolio, we have a sizable position there. And also, we expect inflation to pick up towards 4% at the end of the year. So we've also increased inflation-linked bonds in the portfolio to capture that carry effect. So net-net, there is risk in the portfolio for now. But as our clients know, we manage this portfolio very actively, and whenever new material information comes in, we will switch around the position. That's who we are.
All right. So when you talk to investors, then what's the key message that you're giving them in terms of risk and reward?
So since COVID, it's been a very tough environment. Our investors know that. And we think the key message we give them is the kind of manager that you need to choose or invest in an environment like this is people that are nimble, because the world is changing and there's a lot of new information that comes through. You can't afford to sit in a mandate that just takes a certain position for 5 years. You will miss pockets of value. So rather look for a very active, nimble manager that can move around and change with incoming information to capture pockets of value here and there.
Not too nimble, though.
Not too nimble. You don't want, obviously, cowboys.
Yeah.
But and that's, a very important point around not being too nimble, because otherwise you may just trade for the sake of doing it. But if you invest in someone that's very experienced, have done it for many years, the team that's also very diverse, you stand a better chance of getting a good outcome as an investor. But I would caution, given the volatile environment, this is not the time for an investor to actively be doing that for themselves, because unfortunately, you seldom come out right compared to the professionals in the environment.
When you say you're picky, how does that inform your thinking?
So we studied at a sectoral level.
Yeah.
We say, for instance, there are some sectors that are cyclical. For instance, I'll use mining. It goes through, peaks and troughs very quickly. It's very hard to take a structural, through the cycle view. So we avoid those altogether in the portfolios. But there are also other names that are very liquid that have been coming, so the supply is quite high. They've been coming to the market consistently, which has pushed spreads quite low.
So what sectors look attractive then?
Banks are those. So we also very picky in that space. So for us, we're looking at more diversified industrial companies. We're also looking at securitization, offers good value at the moment. SOEs as well. I mean, we had stayed from that sector for a while, but given the reforms that have been happening, we are starting to pick up a few names in the SOE space that give us good spreads.
Are you confident that's happening in a more solidified way now in terms of the SOE space?
Yes. So the green shoots are there. The momentum definitely is in the right direction.
Green shoots have got to grow a lot quicker though, haven't they?
Yeah, they have to. But one can argue that, SOEs are headed in the same direction.
And there is progress being made, right?
There's progress being made. And you don't want to wait until a point that they are sorted, because then you would have lost about 100 basis points in the price. So you always have to look through directionally and say, this is where it's headed. I'm going to invest now to capture value for the clients.
Let me pivot. There is a lot of talk about the possible lifting of South Africa's grey listing sooner rather than later. What does that mean, particularly when it comes to foreign appetite for local bonds?
We think it's more noise than anything. When we were grey listed, we didn't see outflows. And at that point, we actually asked a few of our offshore clients that are holding our bonds, and some of them didn't even know what it is. So
there was no material difference?
No, zero. Not from a bond market point of view. And we don't think it's not like a credit rating where you're actually getting kicked out of indexes and all that. It's more from the cost of running business, now the real economy side of things. So we don't think it benefits the market either.
So if there's noise around it being lifted, it might in fact create more appetite.
We wouldn't take a position based on that. It's more for the real economy. It's noise. It's noise, yeah.
It's an interesting perspective. Foreign participation has been a strong theme this year, as you alluded to earlier. Not only what is driving interest right now, but how is that interest likely to increase in the next couple of quarters?
So the first part, what's driving the interest is I'm diversifying away from dollar assets. I'm looking for returns elsewhere. So meaning yields, higher yields. Emerging market economies offer those high attractive yield. And then when you then rank these economies, other than Brazil, South Africa screens very well. So it's very high yields, low inflation, a very liquid market, very liquid currency. So foreigners look at it and say, I can go in, and if I want to get out, I'll get out. So they've been piling in on South African bonds. It's not necessarily a South African specific story. If you look at the rand, it's performed very well year to date against the dollar. It's weaker against all the other measures, meaning this is a dollar weakness story. So the second part of your question is, will the foreigners continue to pile into bonds? Then you need to answer the question around dollar weakness. If this reverses, we are going to see outflows because the fundamental macro story for South Africa is not stacking up. But for now, we think short to medium term, we continue to see the inflows because it's easy financial conditions. Liquidity tends to flow towards high yield.
And there's so much uncertainty around the dollar right now, isn't it? It's a difficult one to call.
It's a very difficult one to call. But the market positioning now is definitely on a short dollar side of things, which is also a risk to watch because if, for instance, the US economy was to start taking off or improving materially, you will see the dollar turn. So if you think our flexible income fund in this strong dollar environment, we're actually now putting on hedges against the dollar strengthening further, just to try and hedge ourselves against that risk, because everyone is expecting the dollar to weaken structurally from now on.
And just a final one then, so much in motion right now, as we've discussed, policy shifts, capital flows, and global uncertainty changes hour by hour. What's your message, Sylvester, to investors trying to read the bond market with a little more salience, with a little bit more clarity?
I would say
Deep breath there.
yeah.
Yeah.
It's a very tough environment. I think investors have to get comfortable with discomfort or with uncertainty for the next for the foreseeable future, right? From many angles, the global or the world is not in a good space. So there will be volatility, which means then it's important to look through the noise. Don't focus on the short-term returns or ups and downs. Just
when you're looking through the noise, what are you looking for?
Structurally. So that's where the fundamentals come into play. That's why I say we're not just going to be buying bonds and sit because money is flowing in. You have to overlay it with the fundamental picture. What's growth like? If the economy is growing at 1% for the past 10 years and your population growth is growing at, say, 4%, that's not sustainable in a welfare state. So it's going to put strains on the budget. So you have to be able to leave it to the manager to make a call to say, I'm getting out of South African bonds, they're expensive. They've done a lot. So leave it to the professionals. Don't try and call it, but also, I guess, make sure that they are nimble and flexible enough to contend with this environment. It's a tough environment.
And that's where we are going to leave it. As we've just heard, the bond market still offers rich opportunity for those who look beyond the headlines, and understanding the short end of the curve can make all the difference. My thanks to Sylvester Kobo, Deputy Head of Fixed Income at STANLIB Asset Management, for sharing his insights. This has been The More You Know from STANLIB, where sharper conversations lead to smarter investment decisions. Until next time, goodbye, and thank you for watching.
STANLIB Asset Management Pty Limited is an authorized financial services provider in terms of the FASE Act. This content should not be construed as advice.